Welcome to TMS Insights. It's now September, which means August has ended, Ben. Reporting season's over and the dust is settling. The black ink is out, and what a season. I mean, the first thing to say is the volatility around reporting has gone to next levels.
Yeah.
Up and down.
Yeah.
And wow, what a season.
I reckon that's the biggest takeout of this. I mean, we can talk about the results and stuff, but in Australia, we used to see volatility in small and mid caps around results. 20% moves were not uncommon, but it almost feels like in 6 months we have gone to a almost US style reaction to results, which I think has got a lot to do with the availability of AI that the autonomous computers have got these days. And we're now seeing 15, 20% swings in the biggest companies on the ASX.
Yeah.
And that's suddenly become normal.
And just the biggest companies. So these are the most researched. They've got 20 analysts doing reports on them.
Yeah.
And the surprises shouldn't be that large and the reactions should not be that large.
Yeah. And also, like, I'd say call out Woolies as an example.
Yeah.
It wasn't a great result, but it wasn't amazingly far from where analysts were expecting it to come in. A 15% drop on the day is... how is that business worth 15% than it was a week ago?
A day ago,
yeah. I mean, how can that be the case? But I think, the AI programs are trained on words to look at in these earnings releases and then told to start selling or buying based on seeing these words.
And the element is getting in early. That's what they're trying to do, isn't it? So they're forming immediate views and actioning in that. And this AI has obviously been evolving in recent years, but it's now we're seeing the actioning of some of this in the markets in which we operate. Clearly, opportunity sits in this space, Ben. That's
100. Well, that's the takeout. Is that I've seen a number of companies report where we speak to a lot of guys in the industry, and this has been on the front page of the Fin Review for the last 2 weeks. So we're not saying something here that's not getting a lot of chatter, but this is where a human might have an edge. Is that you can look at what autonomous trading platforms are doing, and if you've got a longer time frame than 2 or 3 months, and you know and understand the business, taking advantage of these sort of sell-offs and maybe even trimming into the sort of the bounces that you might see in other stocks.
So probably coming into reporting season with more cash might be the objective.
I think
next time around.
I mean, as of a week ago, it's something that was really I was starting to think about, and maybe we wait through to the February one and see if this is going to become
a trend,
permanent thing. But it feels like there's some good opportunities to put cash to work. We might talk about a couple of stocks now, but I think that's...
We talked about Woolies. Let's stay on that one there. So obviously, it's had some issues in recent times. The core business of the supermarkets, Australian, were the focus of this one, but Big W has been a dog for a long time.
Yep.
New Zealand been dog for a long time. But did you think it was less the result and more the reaction? Because it was big.
The reaction was big. I mean, look, it wasn't a great result, but Woolworths has an incredible place in the market in a cozy. It's not a cozy duopoly, but it is a duopoly. And I guess Amazon's one threat I do see coming into the country. It's hitting scale, but the assets just aren't being particularly well run at the moment, but that can change. And
the example is their competitor, which, jumping right into Coles, who've got the upper side of this and the upper hand in that two-way battle.
Yeah.
Their result was very good.
Very good. And they just seem to be, like, to me, the takeout I took from the Woolies result is there's still, Coles is a much simpler business focused on the fruit and veg and the grocery offering. Woolies have got more irons in the fire, and another business we could compare it against is Kmart at Wesfarmers, which reported with the Big W business. But how many times though, Jeremy, have we seen this thing? Does seem like a bit of a cycle where you get one player really doing well. It's got the momentum,
and it was Woolworths 3 years ago,
and it shifts. And it could be that Coles is the expensive one now and Woolies is the cheap one.
Yeah.
If you can, they're still great assets they own.
Yeah, exactly. They both can operate well. Let's jump into Wesfarmers because this is a stock which has been trading around record highs, and it's been a great 5-year performer, one of our favourites. Let's talk about the various parts of their business and overall why its share price, which is done so well, is where it is, Ben.
Well, yeah, I mean, having looked at the result, I actually don't have a clear answer for that. It's a bit like CBA, where it was a great result. And
so you think it's overloved at this level?
Well, it's the earnings multiple is pretty significant.
Yeah.
But it's such a good business and it's so well run and they look after their shareholders. I mean, Kmart again hit the ball out of the ballpark.
Yeah.
This Anko brand that they've got that's growing into America.
And we've talked about that a few times. That momentum's growing, isn't it?
Yeah.
That business.
Yeah. We've got Bunnings is just an awesome business, but it's not going to hit the lights.
It's grown so much, hasn't it? Yeah.
And Officeworks was solid. And the lithium part of their business potentially swinging back to profitability now, which is good. $1.50
capital return.
Special dividend. Capital. It's going to be a little bit franked, I think.
Capital, but there's a good dividend, of course.
Yeah, good dividend on top.
Next dividend tomorrow.
So they're rewarding the shareholders. Yeah. Probably says that a acquisition isn't imminent if they're paying out that.
They've done that a number of times before, of course. That's their style. And it speaks to capital management and looking after shareholders. There's your money back. We've invested it well.
Yep.
We don't need it right now. Here's some back.
Yep.
Very few companies do this.
Completely.
That's why Wesfarmers is in a special category.
And why it deserves a
premium rating,
which
it does have. So, all other ways it looks really quite expensive, but it's quality.
Yep.
Quality pays up. Now let's go into the mining services and mining area with Mineral Resources. We can talk. What a year that's had.
Completely. We could do the show on Mineral Resources.
This was Lazarus with a triple bypass. It's come back from the dead and what did you make of the result? Because there's a lot of noise around the stock as well.
The result was messy with a lot of moving parts, but you can see I met the new chairman a few weeks ago, and I was super impressed with what he had to say about why he was coming on board, the work that he did to make sure he wasn't running a cleanup operation, that he wanted to grow a good quality business, and the changes that he's already made. I think he's putting his imprint there, and the result was actually a beat against consensus expectations. The company is still carrying too much debt. Look, it's swinging around because there's so much debt on the balance sheet at the moment. The equity value is quite low, and so when you've got the lithium price moving around all over the place, it's creating a lot of volatility. But it does, like they hit targets for the iron ore production along this ill-fated toll road, and they've called out an annual level which was above consensus. So hopefully that's getting dialed in. The lithium prices had a massive bounce. So those, and they did say, look, we do have we've compiled a number of assets which, if the price was right, we'd be happy to sell to reduce that debt level down. So they've got levers to do it. And it does feel like it's calming, in terms of operating as a business. Yeah,
there's still a few governance issues. So
there's still a few things to sort out.
But again, good to see that moving in the right direction. Another, I can't help but think of WiseTech when I think of Mineral Resources. Corporate governance code. But again, a good result overall, Ben. It's had some standout results in recent years, and the business is in good shape. Share price comes and goes a little bit, but what do you make of the WiseTech result?
Yeah, I thought it was a great result, and I think one of the reasons that we've seen some volatility is that because they bought a company called E2Open, and that was a New York Stock Exchange business, and they were aware of a lot of the financials that the markets weren't aware of. So they weren't able to give their investors a clear picture of what the financials of the company they were buying and WiseTech were going to look like as they came together. And analysts have really wide-ranging views on this, and I think that's why you've seen the volatility. Most analysts have actually upgraded share price targets coming out of the result, and I thought they did a great sales bill as to the benefits of bringing these two together, because they haven't really been able to talk about it. So, look, the other thing I'd say is the cargo-wise revenue growth was a little bit slower, the consensus than expected, but it's because they're currently doing two of the biggest company rollouts onto platform that they've ever done, Nippon Express, and there's another one. And we've owned this business long enough now to know that during those periods, there's a lot of costs for the business.
It's an investment phase.
It is. And it takes time for that company then
the bottom line. Yes.
And that was the other thing they're doing is changing their pricing model. So a bit like CSL, there's a lot of new
better
info.
than CSL, probably.
yeah, it was better than CSL, but a lot of new info for the market to digest.
Yeah. And it takes a while, but I think it's under $100 and it looks pretty good there.
Buy on the dip, definitely.
I just want to briefly just digress, and we're going to send a video out later in the week that Ben, you did with James Marlowe of Livewire, and I thought it was an outstanding piece that I think would appeal to a whole range of investors, potential investors, and our clients, obviously. So it covered initially portfolio construction and went into private equity, and it's a really great discussion. Credit to you and James for that. Just it's had a huge number of views on Livewire's platform, and we certainly don't want people to miss it because I think there's so much to take away from any. Just some comments to you. You did it. I mean, again, you got the chance to talk about some of the things that we've been doing here.
Yep.
And just maybe a few comments before everybody gets the video later in the week.
Yeah, look, I think for many the feedback actually from Livewire, because I did this video at the start of the year with another advisor, and we spoke about private markets, and they said they had this incredible response in terms of people wanting to learn more about it, how can they allocate to it, and what should they be doing. There's a huge demand in this area.
And a bit of a lack of understanding too.
Totally.
Understanding gap. Yeah.
Completely. So that was the thesis of the video, was to try, because we've spoken about on these videos a bit, for 3 years now, we've been going through this learning journey, I guess, ourselves, and starting to allocate to some funds, which has got off to a really good start, I'd say. And what we've tried to do is more an educational piece, I guess, but talking about some real examples of funds we've gone into, how structures differ, what can be the right fund for different people, all those sort of things.
No, it's really well explained. I think everybody who watches it will enjoy it. So notice that on the emails that will come around later in the week. Just last grab for today, Ben. This is September. Can be a bit of a softer time of year in markets, and we know markets are pretty high. What are we looking out for in the next little while?
Yeah, I think actually September in New York is typically the worst performing month of the year, and there's a whole lot of reasons for that. October's normally okay. And
everybody remembers the crashes, but they don't happen that often.
No, September's actually worse. And there's an old saying, gets set in October for the run into the strongest period of the year. So, it wouldn't be a surprise. I think the outlook for this current financial year is improving, and it feels to me
economically
and earnings-wise. And we've just had another financial year, which has been a bit frustrating. We're not seeing a lot of profit growth in Australia, but it feels like that's changing. The outlook for interest rates is changing. It feels like a pretty good environment for equities to me, which is why I think the market is strong. So, it wouldn't surprise me to see a breather. We haven't had one in 4 months now.
Yeah, it's always healthy. So would be fine. Well, that's all we've got time for today. We'll be back later in the month with another Insights.